a company drowning in over $146 million in losses. Yet Wall Street is betting $764 million that you will buy in. Official filings reveal Jennifer Garner walks away with a guaranteed $7 million, win or lose. While bankers cheer and investors line up, the real numbers tell a story of risk hidden behind celebrity shine. How did a children's brand ignite an IPO gold rush while burning cash at record speed? The answers begin with the valuation no analyst can justify: $764 million. That's the price Wall Street stamped on Once Upon a Farm, a company that has never posted a single profitable year. The number is not a rumor. It is right there in the S-1 filing: 10.997 million shares, priced at up to $19 each, aiming for a market capitalization that rivals legacy food giants. But the math does not add up for anyone reading beyond the headline. On $201.59 million in revenue for the last 12 months, Once Upon a Farm reported a net loss of $48.12 million. That means, for every dollar coming in, more than a quarter is going straight into the red. The valuation puts the company at nearly 3.8 times trailing sales, a premium even in the frothiest corners of consumer packaged goods. Compare that to established brands trading at half that multiple, and the sticker shock only grows. Goldman Sachs and JP Morgan are running the show, but even their involvement cannot explain why a business burning through cash at this pace is being floated at unicorn prices. Investors are being asked to buy into a promise that growth will eventually outrun the losses. But the filings show a different story, one of escalating costs, shrinking margins, and a relentless need for new money just to keep the lights on. The IPO is not about celebrating a breakout success. It is about selling a narrative and hoping the market buys it before the losses catch up. The $764 million figure is not just a valuation. It is a mystery begging for answers. And behind that number, someone stands to win, no matter what happens to the stock. Jennifer Garner's name is everywhere in the prospectus, but the S-1 filings bury the real headline: a cash schedule that guarantees her $7 million through 2028, no matter how the business performs. The numbers are spelled out in black and white. $2 million due in January 2026, another $2 million in 2027, and a final $3 million payment in 2028. All of it is tied to her continued role as the company's public face and the use of her family farm branding. This is not stock options or some performance bonus. It is hard cash, locked in, while the company racks up tens of millions in annual losses. The contract was signed in 2022, right as Once Upon a Farm was preparing for its IPO push. It is structured as deferred compensation, meaning Garner gets paid regardless of whether the company ever turns a profit. The S-1 does not just confirm the payout, it shows the money is coming straight from the funds raised in the IPO. Investors are buying shares in a business that has already set aside millions for its celebrity co-founder, even as it burns through cash at an accelerating rate. Garner's payday stands out for another reason. She is not just collecting a salary, she is also a major equity holder, with more than 3 million shares after the IPO. At the top end of the company's proposed valuation, her stake could be worth over $55 million. But the $7 million in guaranteed cash is the real kicker. It is a safety net for Garner, financed by new investors, while everyone else is left holding the risk. The documents reveal a simple truth. In this IPO, the celebrity wins first, no matter how the story ends. John Foraker did not just walk into Once Upon a Farm with a famous co-founder and a fresh logo. He arrived carrying the weight of a blockbuster exit, $820 million, the price General Mills paid in 2014 to buy Annie's. the organic food darling he helped turn into a Wall Street trophy. That deal cemented his reputation as the guy who could take a small, mission-driven brand and turn it into a juggernaut. His name became shorthand for credibility in the natural food space. Venture capitalists lined up, eager to back his next project. The Annie's acquisition was splashed across business pages as a textbook win, with Foraker hailed for steering the company from niche to mainstream without losing its soul. But lightning does not always strike twice. Once Upon a Farm is not Annie's. The organic pasta boom of the early part of the decade that began in 2010 handed Annie's a tailwind, distribution deals, margin expansion, and a consumer base hungry for clean labels. Foraker's playbook worked because the market was primed and the numbers followed. General Mills paid a premium for scale and growth. Now the landscape is different. Once Upon a Farm is fighting in a crowded, cutthroat category where refrigerated baby food faces relentless pricing pressure and a shelf space war with legacy giants. The margins are thinner, the logistics are brutal, and the path to profitability looks more like a maze than a runway. Foraker's resume is impressive, but S-1 filings paint a different picture this time. The company's rapid sales growth comes with escalating costs, and the bottom line has yet to see daylight. Investors are being asked to trust the pedigree, to believe that past glory guarantees a repeat. But the numbers do not care about reputations. Annie's sold for $820 million because it was profitable and scaling. Once Upon a Farm is burning cash just to keep pace. The leadership halo only goes so far when the red ink keeps spreading. Losses are not just a footnote buried in Once Upon a Farm's filings. They are the headline. The S-1 lays out a brutal arithmetic. $48.12 million lost in the last 12 months on $201.59 million in revenue. That is not a one-off stumble. Year after year, the red ink deepens, with each quarter piling on more debt. There is no sign of a turnaround, just a company sprinting through cash, hoping the next injection of capital arrives before the tank runs dry. The company's own numbers show the pattern. In 2023, losses hit $17.6 million. In 2024, that number climbed to $23.8 million. By the first half of 2025, they had already burned through $28.5 million. It is a runaway train, and the brakes are nowhere in sight. The burn rate is not slowing down. It is accelerating, leaving a trail of mounting deficits that now tower over $70 million before even counting the latest full-year loss. Every dollar raised in this initial public offering is fighting a current that is only getting stronger. The filings do not offer a plan to reverse the flow. Instead, they promise growth, while the losses keep outpacing every sales milestone. Cash from the offering is earmarked for paying down debt, buying equipment, and covering general corporate purposes, a phrase that usually means plugging holes just to keep the lights on. There is no clear runway. If the current pace holds, a raise of $200 million could vanish in months. The company's survival now hinges on Wall Street's willingness to keep the money tap open. This is not a growth story. It is a countdown, and the clock is running out. Goldman Sachs sits at the top of the deal, but they are not alone. Once Upon a Farm's IPO is being shopped around by a syndicate of 10 banks, each with a slice of the action, and a big incentive to push as many shares as possible out the door. The underwriting agreement spells out the terms. For every share sold, the banks collect a combined fee that can reach up to 7% of the offering. That is millions in immediate revenue just for finding buyers, regardless of what happens to the stock once the opening bell rings. The mechanics are simple and ruthless. Management fees, underwriting fees, and selling group concessions are divided up, with Goldman and JP Morgan pocketing the largest cut as lead bookrunners. The rest of the syndicate, names like Bank of America and William Blair, scramble for their share, hoping to flip their allocations before the market sniffs out the losses buried in the S-1 filing. The more they place, the more they earn. If demand falters, banks lean on their institutional clients, offering sweeteners and inside access to other deals. It is a volume game, not a long-term bet on the company's future. Behind the scenes, the lockup clause keeps insiders from dumping shares for 180 days after the IPO, but that does not apply to the banks. Their risk is capped at the underwriting discount. Any shares they cannot sell at the IPO price are typically offloaded in the aftermarket, sometimes at a loss, but often with little skin in the game. The pressure to distribute is immense. For the syndicate, this is not about believing in Once Upon a Farm's mission. It is about moving product and collecting fees before the music stops. If history is any guide, the banks will be gone long before retail investors realize what they have bought. Jessica Alba's Honest Company stormed onto the public markets in 2021 with a billion-dollar promise and celebrity sparkle. Wall Street could not get enough of the story. Then reality set in. Within months, Honest's stock chart fell like a ski slope. The company lost nearly 80% of its value, wiping out hundreds of millions in shareholder wealth. The numbers do not lie. From a $1.4 billion debut, Honest now trades at a fraction of its initial public offering price, battered by weak margins and brutal competition. Investors who bought into the hype paid the price. The celebrity IPO curse is not just a headline. It is a pattern. Public relations teams and bankers build the perfect narrative: star power, mission-driven branding, and a better-for-you product. But when the numbers cannot keep up, the market turns savage. Honest's collapse was not an isolated event. It is a warning shot for every investor staring down another glossy prospectus stapled to a famous name. Contrast that with the outlier, Kim Kardashian's SKIMS. While Honest bled value, SKIMS exploded to a $5 billion valuation, fueled by direct-to-consumer margins and relentless demand. The difference is blunt. SKIMS built a business that prints cash. Honest built a brand that burned it. The lesson is brutal, but simple. Celebrity can open doors, but it cannot save a broken business model. Once Upon a Farm's initial public offering lands squarely in this danger zone. The bankers are selling a vision, not a proven path to profit. Charts do not care about red carpets. The Honest Company's 80% crash stands as a billboard-sized warning for anyone who thinks star power is a substitute for sustainable economics. In the end, Wall Street's memory is short, but the losses are permanent. $6 for a single baby food pouch. That is what Once Upon a Farm is charging in grocery aisles across the country. 4 times the cost of the $1.50 competitors lining the same shelves. The numbers are not an accident. This is a premium play, built on the idea that parents will pay up for organic, cold-pressed, and celebrity-backed. But the math is brutal. Even with 68% of sales coming from these pouches, the brand's household penetration has crept up to just 4.4%. At this rate, the company would have to conquer every upscale parent in America just to scratch the surface of a market cap of $764 million. The so-called luxury baby food strategy locks the business into a narrow slice of the market, one that caps real growth at 15% of the total category, according to industry estimates. Every dollar of revenue is squeezed by thin margins, retailer markups, and relentless price pressure from cheaper brands. The higher the valuation climbs, the harder it is to justify with actual sales. For investors, the promise of premium pricing is starting to look like a trap, set by the laws of basic arithmetic, not just Wall Street hype. Buried in the S-1 filing, Once Upon a Farm's legal DNA reveals a structure most investors gloss right over. It is a public benefit corporation, PBC. This is not your standard Delaware C corporation. The PBC charter gives the board power to put mission before profits, creating a legal mandate to prioritize nutrition, sustainability, and social impact, even if that means sacrificing shareholder returns. The fine print spells it out. Directors can weigh the interests of children, farmers, and the planet alongside financial outcomes. For investors, that means profit is not always the final word. The company's expansion into adult snack bars and protein blends blurs the line even further. Are these strategic pivots for growth, or just more mission-driven experiments that sidestep hard economics? The ambiguity is by design. With the PBC clause in play, the board is not legally bound to chase maximum returns. If the numbers do not add up, investors have little recourse. The feel-good mission becomes a shield, and the risk of being left behind grows with every new SKU added to the roster. High-pressure processing is not just a buzzword on the label. It is a financial anchor dragging margins underwater. Every cold-pressed pouch relies on high-pressure processing machines that cost millions to install, and even more to run. Once Upon a Farm does not own this infrastructure. It rents capacity from contract manufacturers, baking high fixed costs into every unit. The S1 filing risk factors spell it out. Any hiccup in high-pressure processing supply, and shelves go empty. But the bigger threat is not mechanical. It is geopolitical. Nearly half the fruit and vegetables in these pouches cross the border from Mexico or South America. One tariff hike or trade war, and ingredient costs spike overnight. The company admits it has no control over these shocks. For a business already bleeding cash, a 10% tariff on imported produce could erase what little margin remains. And then comes the real fuse, the initial public offering lockup period. Standard terms mean insiders, early investors, and celebrity co-founders are barred from selling for 180 days after listing. But as soon as that window closes, likely in August and not in February, the market could face a flood of shares. Tens of millions of locked-up shares become eligible for sale overnight, with pre-IPO backers and insiders holding more than 70% of the company. If the stock stumbles, the exodus will be fast and brutal. Wall Street's syndicate gets paid either way. But for everyone else, the countdown to a potential share dump has already started. The margin squeeze is not theoretical. It is a ticking clock, and the timer is running out. Today, celebrity initial public offerings keep rewriting the playbook. Private losses, public risk, and guaranteed payouts for insiders. Wall Street's appetite for hype outpaces its appetite for profit. As billions chase the next big name, the rules bend, but the risks do not vanish. In this market, the only safety net belongs to the stars. Drop your thoughts below. Does this change how you see celebrity brands?